Hi, everybody. Welcome back to our podcast, The Ins and Outs of Selling a Business. I'm kdee, President of Osage Advisors. We're excited to have back with us today Peter Learman, who is the founder and CEO of Axial. Axial is a deal platform that is focused on the lower middle market. It allows advisors like us to get greater visibility into the buyer pool and then look to select specific buyers that could be a good fit for our clients. Peter, welcome back. Great to have you here. I know you're a busy schedule, but we greatly appreciate your time and got a lot to talk about today and happy to have you. The visibility question is, and we had this in the first quarter of 2023. We pulled two deals. We pulled two deals from market because we got a lot of offers in, but the valuations were suppressed because no one knew what 23 was going to be like, right? You remember Ukraine war hit, interest rates are rising. People thought the fourth quarter of 2023 was going to be, another great recession. And so looking at that visibility, what's the next 12 months look like? No one knew. So they said, look, I like your company, but I'm willing to pay X for it today because I'm not sure where things are going. And so we had a couple of deals where we actually pulled from the market then because, hey, we need to get a better visibility so you get the right price for your company. Unless there's any specific, unfortunate reason you need to sell now, right? Like a health issue or something. But as you said, buyers will buy based on growth. They pay based on historical profitability. So, we put a big emphasis on growth in our SIMs, the focus on that. And we get tons and tons of questions on that as we go forward and preparing our clients for that question. Cause a lot of, let's call them lower middle market companies, most of our clients are less than $100 million in revenues, right? They have a plan in place, but it's not really memorialized in a document, business plan, forecast, whatever. It's kind of like in my head, we have an idea what we're going to do. And then communicating that in a concise way to a buyer pool sometimes could be challenging. So we spend a lot of time with our clients talking about growth, what are areas of growth. And you'd be surprised, or not surprised, but during these management presentations or initial Zoom calls that we have with some specific buyers we feel are good buyers, we have to interact or inject. Hey, hey, Mark, remember that, don't forget, you have this new machine coming in for this client that's you got a big order going to come in on top of that. Oh yeah, by the way, they, all of a sudden, because they're getting inundated, they're in a comfortable environment, right? They're talking to a new buyer and some of these things they know about, but it doesn't come to the forefront because they don't usually talk about it. So our job as advisors is to, remind them during these conversations to bring those things up. So, it get the buyer pool more excited. So, it's really an interesting dynamic. As you said, the buyer pool has changed dramatically over the last, 10, 15 years, and you guys get a lot of statistics, at Axial. So, maybe to share the kind of buyers you're seeing really active these days. I don't know if it's any specific type of buyer, it's a broad-based buyer, how you've seen the landscape shifting maybe over the last 3 to 4 years, post-COVID or pre-COVID. What kind of things are you seeing out there right now?
Well, I think the change in the buyer universe is definitely, I would say it's a great thing for owners of businesses in many ways because it represents an increase in the types of people who you can sell your business to and who can be your business's, partner in the next chapter. And so that's a great thing. And the reason that it's not a bad thing, but a challenging thing is when you have more choice and when there's more variety, it's harder to kind of parse it all and navigate your way through it. And so I think M&A advisors and business owners have a harder job today than they did 20 years ago, 30 years ago, in terms of really navigating all the different sort of types of buyers that are in the market who could potentially be a great partner for your business. So it's good in terms of choice, and it's bad in terms of choice because there's a lot that has transpired. A couple of what do I mean by all this choice? So in general, to your point, the market of private equity has grown very significantly over the last 20 years. As you said, 1,000 private equity firms to 5,000 private equity firms today. What does that mean? Well, you might just think that means 5 times as many potential private equity buyers, but in some ways it actually means a lot more than that. And let me explain that. Private equity firms used to buy businesses, and for the most part, in order for them to generate a return on those investments, they bought those businesses, and for the most part, they just let them grow and grew them. Maybe they cut costs, maybe they did a great job, maybe they did a bad job, but they didn't focus a tremendous amount on making additional acquisitions once they had bought a company. That's totally different now.
Yes.
Most private equity firms today will buy a company, and before they've even bought that company, they have a very, very clear mandate, and in many cases have gotten down to a specific named list of other businesses that they want to acquire once they've bought the first company. So they're going to grow that business not just by organically adding customers and and driving products and pricing and customer count up, but they're going to be growing that business maybe disproportionately by making small additional acquisitions. So it's not just like these private equity firms that you have to be able to know and to access as an owner, but you have to realize that there's now all these trade buyers that are much more acquisitive than they used to be. Because once a corporate buyer is owned by private equity, their propensity to make acquisitions goes way up, way up. So you don't just have to know the private equity firms, you now have to know all the different companies that are owned by private equity and how those businesses are different from family-owned corporations or founder-owned corporations. So huge expansion in the number of buyers that are out there, not just the investors, but the companies that they already own. And to be honest, I mean, I could go on and on. I mean, that's just the start of it, but there's family offices that are now investing in a way that they used to not. There's just a lot of new entrants.
Yeah, it's
And
interesting.
some of these entrants are easy to find. Some of them are hard to find. Some of them have a very low profile. Some of them have a high profile. There's a lot of work to do to sort of figure out what's that ultimate list going to be? You said 8 to 10 buyers, right? You got to go from this huge funnel, big, huge, wide funnel of potential buyers. You got to ultimately get it down to a manageable number, because you're not going to ask the business owner to meet with 100 buyers. You're going to have them try and meet with a much more manageable set at the end of the day. So it's a great new world in terms of choice, but it's a very hard new world in order to winnow it down and get it to the right final group.
Yeah, I would say, for us, we're low middle market. So the majority of our companies would be quote unquote those add-on acquisitions, right? So when we're dealing, and I would say, we definitely get a significant interest of private equity firms, but they whittle down at the end of the day. I mean, we could put out 200 books, we'll get 8 to 12 bids. We can put out 50 books, we'll get 8 to 12 bids. But what's important for us, for our clients, is to understand the buyer, right? Because they come up and where they are in the life cycle of their fund. Are they at the beginning of the fund, the middle of the fund, the end of the fund? And then also, we need to be inquisitive to them, which we recommend our clients do the calls. Is like, look, we need to talk to, we're down to a couple buyers. We want to talk to some current and former CEOs of companies you bought that are working with you today and find out how it's working out for them, right? Because you're now going to be managing up. If you're being bought by private equity, likelihood you may roll some equity, stay with it for a couple of years, get second by the apple, or at least a couple of years, running the business. You need to understand the dynamics. And if that buyer is unwilling to provide that information, it's a red flag, right?
100%.
No,
100%.
They're out. And it's interesting. We had one client, he made 27 phone calls to see current and former CEOs of portfolio companies, right? And we had another
That's a lot of
client.
reference calls. Good for him.
He really wanted to make sure that he was doing the right deal, right? And then we had another client that the equity fund told us, said, look, you could roll equity with us, but we want you to know that we're at the end of this fund. And they were transparent about it, which is great. But you're not going to see a huge return on your reinvestment because we're probably going to be selling out of this in a year from now. Now it was the right buyer. There's a lot of dynamics behind it. He was a minority shareholder. There's a family issue, state issues, whatever, but it was the right buyer. But he said, okay, I appreciate that, but I'm still going to roll, a couple $100,000 into the deal. He felt more comfortable doing that. Right. But at least, where you're at, because if you're at the middle of a cycle, beginning of a cycle, and you roll equity and you're not the platform, you're the first or second deal in, and they execute appropriately and correctly and on their vision, there's a good chance that second bite of the apple could be substantial, right? Or not, depending on who you're dealing with. But those equity fund, understanding where they sit in their fund cycle and their success rates, is critical.
And also just sort of what's going on in terms of the market that they are trying to sell into. So for example, if you were a private equity firm and you bought a lot of businesses between 2019 and 2021,
right,
it's very hard for you right now to sell businesses because you probably bought businesses in a very different interest rate environment, in a very different geopolitical environment. We weren't fighting Russia. We didn't have static with China over Taiwan the way we do now. We didn't have 5.5% interest rates, right? There are a lot of things that were different in the late 2010s versus where we are post-COVID, 23, even into 24. I mean, 24, I think, has been a little bit more bullish from a sentiment perspective, but there's a lot of risks out there, and the price of capital is much higher. So if you bought businesses as a private equity firm in 2018, 2019, 2020, you're struggling to figure out how to sell those businesses because the valuations have moved down, the cost of debt has moved up, and as a business owner, you have no reason to understand these market forces. Like, right, you're building your company. You shouldn't be focusing on these things. But before you end up selling your business, you kind of have to understand the game on the field. And I think that's a place where veteran bankers who have seen market cycles, understand these things, can be really, really helpful. I mean, it's not just understanding the buyer list and telling the story and doing a lot of work to insulate the business owner, and it's also helping them understand like the broader context in which the transaction is taking place, and just making sure they understand that stuff, because you just couldn't expect owners to understand all of this stuff and be building and running their company. That's not a reasonable expectation to have on a CEO. So
yeah, we spend a lot of time in that education process. I mean, because we get down to that, that shrinking pool of buyers, and we imagine presentations, and like I said, nothing's more important than the right buyer is the right fit. I mean, it's part of the whole value proposition. It's not just a price. And I got to tell you right now that I would say half our deals, our client does not take the highest price. He feels the number two buyer is a better fit culturally for them. Will continue the legacy of the firm, whether it's first, second, third generation, and providing a environment that their employees will still have a job afterwards, and that's critical for most of our clients. The education is that when we get down to those last 4 or 5, is like I said, it's time for us to really delve deep into the buyer, where they are in their cycle, their funds, understanding them. Our clients need to make some phone calls along those type of things. And those are all critical factors that are nuances, but are very critical to a successful transaction. And that's where, we doesn't get a lot of press, but that's where I feel from our perspective, as I said to our clients, we're available 24/7, no matter how small you think the problem is. If it's a concern, you call us up, we need to find a solution. And our team knows that. It says, if our client has a concern, I'll give you a quick example. We have a deal actually right now. It's closing as we speak, right? The closing call is at 10 o'clock. I can't be on it. It's just, and those closing calls are so anticlimactic. It's like, is everybody good? Uh, um, yes. Are we ready to close? Yes. And that's it. After a year, that's the call, right? But it's like a whole new world starts the next day. So we try to add value there, and that's the most important thing. Is that so? This client, we had an internal call Monday or Tuesday, and with our attorneys and our accounting firm and whatnot, and the two partners on the call, and I'm listening to it. I'm saying to myself, something doesn't feel right to me, right? So as soon as that call ended, I picked up the phone. I called my client. He goes, "I'm glad you." I said to him, I won't use his name. I said, "Steve, um, I sense there's a concern, some things that were mentioned during this call. I just want to call you and just talk through them with you. So I'm glad you called. I got my partner on the phone, and he dialed him in. And we spent an hour on the phone, just talking through a lot of stuff we've already talked through. But again, this is the biggest decision they're making in their life, right? So
Yep.
I spent an hour on the phone talking to them and just listening to them and just giving them my perspective based on my history, based on my experience of how how these things are going to work out and get them comfortable with it. And at the end of the call, they said, "Thank you. We appreciate it. We're good." But if I didn't pick up the phone, if I wasn't the advisor, if no one was the advisor, if he was calling his attorney who is there to protect him, right? He may not have gotten the same kind of answer. And they could have just got really frustrated and walked away from a deal that was good for both of them
Right.
without having good
Right.
communication.
Right.
So those are the type of things that, are values that we bring to the table. And, and Axial, again, delivers what I call high qualified buyers that we look at, and we don't invite them all in, but we do invite some of them into our process, which is an added value to our clients in the long run. So Peter, before we wrap up, I think I really
I was
appreciate.
just going to say something, Keith, on
Go ahead.
what you just said in terms of spending the 60 minutes right with an owner, kind of as because it's a huge deal, and in the days or weeks as it's getting closer and closer to sort of closing, I mean that is a really, really intense emotional time, even if it's exciting or whatever. And it's one of those times where it's like, you know it's kind of like when a parent, like one of their children is just like has their first boyfriend or first girlfriend, and they just can't really see can't really see necessarily the forest from the trees. They're overreacting in a way to something, or it's a very emotional period. And like, without somebody who kind of has a little bit of distance and perspective from it, it's just really hard to sometimes like navigate those periods. I also think that like business owners are just always worried when it comes to these decisions, like, are they somehow about to get screwed? Are they
Right.
somehow about to get taken? And it's like, it's such a powerful source of hesitation, because you just don't want to be the owner that gets screwed. You don't want to be the owner that, doesn't get appropriately treated. And so like just the slightest amount of doubt on like a topic like that can just explode into this like huge thing. And to your point, then like the deal is off. And the truth is that there probably are times when that is about to happen, right?
Mhm.
And then there are times when they feel like it might be about to happen, but it's not. And so yeah, it's a tough period. And to have a good coach and a good advisor during that period, like obviously that can be incredibly helpful, right? So but it's got to be a really good coach, right? It's got to be a
Yeah.
really good advisor. Not every M&A advisor is going to be outstanding at helping an owner navigate those tough moments. Some are going to be better than others. And so it's for an owner, it's not just about like whether or not you hire an M&A advisor. That's not quite good enough. You have to hire an excellent advisor. You have to hire someone who is going to be very high value and high impact in these key moments. You can't just hire a broker of one kind and just check the box and be like, okay, I'm going to be good now. Unfortunately, as an owner, you've got to make a more nuanced and more impeccable decision in terms of who you hire and who you sort of put by your side through all this. So I
Yeah.
just wanted to like really punctuate that.
Well, I greatly appreciate it because, at Osage, we value the relationship more than anything. And I always, the relationship is more important than the transaction. It's got to work for our clients. And, we have advised our clients, when we're down to that, I call it the last 72 hours, it doesn't feel right. Just walk. We'll just go back to market another time. It's got to, you don't get any, it's got to work for you. Right. So the relationship piece of it is paramount. And our team knows that. And one occasion, several occasions over the last 23 years plus, we have said, if you're not feeling good about this, just let's walk. Let's cut it off.
Yeah.
And we'll go back to market and find a different buyer in a different time. And that works for you. So yeah, I can't agree with you more. I mean, it's finding that advisor like us that, it just has to work for you. So,
Yeah.
So before we wrap up, this has been great. I'd love to get any perspective that you feel like we're ending up this year, going next year. Any specific trends you're seeing as we go into it? I mean, I'm excited. I believe 2025 is going to be a very active year in M&A. It's been active for us, frankly, in 24 as well and 23. But I see this pent up demand. Our sellers, time doesn't stop, right? And people need to make some decisions. What are you sensing out there? Because you have a much better pulse of it than I do because of your broad perspective.
Yeah, I mean, I think that I think the election was important in terms of increasing visibility, right? So now that the election is over, and now that rates have either flattened or are slightly declining, right? I think that a lot of buyers feel like they have a relatively full deck of cards on the next few years. Rates are flat to slightly down. Unless something really bad happens or something really surprising happens, rates will probably sort of not move around nearly as much as they did between 2022 and 2023, where they took this incredibly rapid rise. So rates more stable, maybe slightly up, maybe slightly down. Political visibility is now clear, right? So what does that mean? So generally speaking, that is the recipe for a more active deal making environment. Visibility up, deal making activity up.
Yep.
I would say a couple other things. The tax cuts that were passed in the first Trump administration had an expiry in many cases of 2025, end of year.
Mm-hmm.
So I think in a Biden, Harris, and then Harris Waltz administration, I do think that it would have been probably fairly likely that those tax cuts would have expired. And I think that would have created a certain amount of urgency in 2025 for certain owners to say, let's sell before these tax cuts expire, right? I think now with Trump and a different House of Representatives and Senate, that those tax cuts probably will get extended in some way, right? So I think there will be, in some ways, a little bit less of a forcing function in 2025 for certain owners to want to exit. So I think that's interesting. It may create less pressure for owners to sell in 2025, even if it is an excellent and active, high visibility M&A environment. The third thing that I think is, kind of interesting is just like for those companies that may or may not be impacted by tariff and tariff strategy, how does that change supply chains? How does that change cost of goods sold? Are you on the right side of that change? Are you on the wrong side of that change? Is it unclear how that affects you? I think that's going to be important. I think owners that are in some way related to some of those considerations are going to need to have like a good, clear story for how they're going to adapt, how they're on the right side of it, how they're going to manage that they're on the wrong side of it. So I think there's some up arrow, like plenty of up arrows that will push activity up. I think there's a couple of arrows that might create lack of visibility in certain pockets of the market. Generally speaking, I would think it's going to be a pretty robust environment. I think that there's going to be meaningful selling activity, and I think there will be meaningful buying activity. So I don't think there'll be a huge change from 24. I would say up slightly to medium. I wouldn't consider it to be like a booming year like 2021 was, but probably pretty strong for those reasons and probably some others as well.
Well, Peter, thanks for being with us today. Greatly appreciate your insights.
Yeah,
Congratulations on
great to be
Axial.
here.
It's it's an important platform for us, and will continue to be so. And maybe down the road we can have you back again to be a guest and maybe check in on 25 at the end of the year and see where things are going. And look forward to catching up with you soon.
That sounds great, Keith. Thanks for the opportunity, and it's just great to be with you. And congrats on everything you've achieved with your team.
Oh, thank you very much. Uh, Thank you, everybody, for being with us today. My name's Keith D., President of Osage Advisors. If you enjoyed our podcast, The Ins and Outs of Selling a Business, feel free to subscribe to our YouTube channel. To learn more about Osage Advisors, you can check out our website at osageadvisors.com. You can email me with any questions you have at kdee@osageadvisors.com, or feel free to pick up the phone and give me a call at 860-767-3273. extension 1001. Thanks again for being with us today, and have a great day.